ratios to purchase stock. We pay a lot of different aspects as to what stock is. Part of our reality when we purchase things like that, there's an emotional connection to it. I've got a list of probably 30 different stocks I'm tracking on a regular basis. And it's not really based upon, gee, mathematically, this is going to be the ultimate thing. I'm paying attention to what the world is like. Okay, there's $51 trillion allocated by the Paris Accord for the aspect of changing the whole world to clean energy. Frankly, I don't think it's really going to happen that way, but I do think there's going to be an effort by it. There's a huge amount of money. So I'm paying a lot of attention to different aspects of mining in the aspect of cobalt, lithium, what's out there, nickel, some of the big mining areas that are not existing because right now China dominates about 80% of the world's lithium and rare earths. So I'm paying attention to what other places they're finding new deposits of it is, because we're going to have a big shift in our economy. So I'm watching that. I'm also watching the petroleum industry, because the reality of petroleum is the fact that even though we may wish for it to go away, all those cars that are still powered by it will still be here for the next 20 years. I'm watching that. I'm watching technology. Technology goes up and down, it crashes and burns, but AI is taken off. So NVIDIA and other ones like that, I'm watching them. There's a whole series of things. And then when I get serious about the idea of, I'm going to buy stock, yes, I'm going to do it now, then I start doing the ratios. But at first, I'm tracking it by emotions, and that probably isn't the best thing to talk about, except for the fact that's how I do it. And then when I get serious about buying it, I pay attention to the ratios that's involved instead of spending time on mathematical calculations. And here's the ratios that really are the most common. If you go out there and take a look at them, price to earnings ratio, price to sales, price to book, even debt to equity, although that changes a lot from industry to industry, and then return on equity. Those are the 5 ratios that are commonly used in the market to actually figure out which ones are out there. And you'll have some people going off on other tangents, especially the brilliant ones that sit down and they dive into very clear ratios and they get involved into heavy-duty mathematical calculations. But some of us leave that for the computers to do, plug this in, and boom, it happens. So let's look on the price earnings ratio. First of all, this is the one that's most commonly out there. EPS, earnings per share, is probably the most critical number to always know. EPS is published in just about everywhere. Wall Street Journal, Forbes, Motley Fool, the whole bit. They all have that in there, and they put it out there on a regular basis, daily, and then they update it as it goes through. Well, a PE ratio, your price to earnings ratio, you take really the current share price of the stock and you divide it by the EPS. That tells you how much that the investors are willing to pay for each dollar of earnings. It also indicates if it's overvalued or maybe a little bit too much money on it, or undervalued. I'm looking for options out there that are undervalued, stock that is undervalued, to see where it sits. That way I can buy it, and the rest of the market may realize, oh, that's undervalued too. I got to go catch up on that one. Yes, and the price goes up, and I make some serious money. That's the idea of really paying attention to what the stock market's all about anyway. So price to earnings ratio is by far the most used ratio. Now you have price to sales. Now that being said, you take the share price and divide it by the company's revenue per share. It sounds a lot like really the price earnings ratio. It's a little bit different because it's not about earnings, it's about overall revenue, but it does give you the aspect to see whether or not that ratio is overvalued or undervalued. Either way, if you have 2 ratios in a row coming undervalued, all of a sudden your intended bet start better going up, saying, oh, here's one. This could be it. I could become wealthy. I could become the next Warren Buffett. Well, maybe just the guy down the street. He's pretty good. Okay, so that being said, pay attention to that one. The next one is the debt to equity ratio. You take the company's total debt and you divide it by the total equity that's out there. That way you get a ratio as to really how much debt the company has in relationship to the actual equity. And equity, of course, we know really is that portion that is owned by the shareholders in there. So a high debt to ratio means that the company is at risk of defaulting on its debt. You don't want that. You want to make certain the company is not going to default, except you're going to have huge differences between different industries. The auto industry is going to have a lot of debt because of the fact just to set up one assembly line is probably $1 billion. So that being said, that's very different from having a fast food company or some other company, a medical device company, or even a biotech company in the process, because you'll see the industries are very different. So be careful on this one because you'll have massively different ratios as you start shifting between the different industries. So watch it. Don't make the assumption that what one applies over here for a mining company or an automotive company is the same thing as a medical device company or some type of fast food chain. They're totally different aspects because the industries are very different. Return on equity. You calculate it by dividing the company's net income by the shareholders' equity. It sounds a lot like this one over here, debt to equity, except now we're going to talk about really looking at the net income and divide it by the shareholder equity. It tells you how much your profit is generating from the shareholders' investment. You put this much money into it, boom, it's like cranking up money. And then you can look on that, compare that company to the industry and see what's going on. It really can vary depending upon the industry, but a high return on equity, that means the company is well managed. So you're looking for people that are out there, leadership that's moving the company forward with the money that the stockholders have invested in it, in the equity aspect of it. So you pay attention to all the different aspects of it. Here's what you do with the ratios. Identify the most important ones for the industry in which you're investing. Like the PE ratio is almost always critical, but the PE ratio is especially involved with the technology industry. And you're looking at the debt to equity ratio for companies that are in the utility industry. Two different aspects of it. Now, I pay attention to all of them. I compare all of them to the industry itself, but how you go about using these ratios is up to you. Then compare the company's ratios to its peers within the same industry. That's going to tell you if you're above average, below average, or in line with the average. Ideally, you want to get somebody that's undervalued and you're paying attention and that's strongly managed. Consider the growth prospects. Really look at the justify the high PE ratios, the company with low growth prospect. You can look at that. So it depends upon what you're doing, and you want to start balancing things out that compare to the industry that's out there. So make a decision about whether or not to purchase the stock. Ratios, feelings, a mathematical formula, none of this makes any guarantee of success, but it does make you feel better about your decision in the process, and then might add a little bit of rationality to your investment decisions. You can say, well, I calculated these 5 ratios over here, and I found this, and that way, if you lose money, you can always justify your actions. Or more than likely, if you pay attention closely to the ratio in the industry, and that the industry grows, your stock price and overall value will also grow if life is good and everything is just and the universe is smiling at you. Take care.